Well, it gives me great pleasure to welcome Chris Woods of Jefferies, a very old India bull and a very good dear friend of mine. Chris, good morning. Thank you for joining us. Chris, let me first start with your worldview. Global financial markets have made a reasonable comeback of 15 to 20% from the recent lows. Do you think the strength is here to stay?
No, my base case, I have a slightly complicated view right now. My base case in recent weeks is that it was to be expected to have a snapback rally. Personally, I would be surprised if we do not sell off again and retest near the previous lows. But I think, having said that, I believe the key issue right now is when do governments start to try and get their economies going again. So my new quarterly, my big picture point is that a big buying opportunity for Asian equities should present itself in this current quarter, because my base case is that the virus infections will peak out in Europe in the middle of this month, which is about now, and hopefully in the US by the end of this month, but earlier in New York. And my base case is that activity will start to resume next month, which means that hopefully in June things are returning to normal, which means that should represent a buying opportunity for equities. However, if I'm wrong on the normal life being resumed, clearly we can sell off to old lows again. What has repelled the markets on this bounce is first and foremost the policy response, but we've also seen some encouraging news that cases of the curbs flattening in Europe, and we've also seen encouraging news in New York. And clearly, world markets are correlated around Wall Street, and clearly the epicenter of the virus so far in America has been in New York City.
Why do you think markets will sell off and we could retest lows? If you think the improvement on the virus front, on the lockdown front is going to get better, what calls for the markets coming down?
There's a risk we don't retest the lows, but we will definitely retest the lows if my assumption is wrong and the governments keep the lockdown in place, the lockdowns in activity for longer. So we have a growing. We haven't had up till now because people until now people have been very focused on the lockdown, implementing the lockdowns, slowing the rate of infection and hospital admission to try and allow hospital systems to cope. What they call flattening the curve. So that's been the focus on the virus, but in my view, if I'm right and it becomes clear that the curves are flattening, that the infection rates are slowing, then the key question will become how quickly activity is turned back on. There will be a debate between the medical people arguing for caution and politicians like U.S. President Donald Trump wanting to reactivate activity sooner. If the medical people win the argument, we stay locked down, I think there's a very good chance we retest new lows. So I think that's the key variable. I think India is a good case in point. India's, I believe, coming to end of a 3-week lockdown. If India imposes another 3-week lockdown, I think the Indian markets sell off. There's a trade-off between fighting the health scare and the economy.
Why is India... Chris, why do you think Indian markets this year are underperforming global markets? Even though on the medical front, the lockdown so far medically has worked, the number of confirmed cases in India are much less than other countries. So on the medical front, if the news is good. On the crude front, if the news is good, why is India selling off much more than others?
Now, the Indian market was doing badly before this medical issue appeared, because we continue to have a complete lack of evidence of a cyclical recovery in India. We had a disappointing budget. We've had, as I said, no evidence. There's been zero evidence of a capex cycle returning in India. There's been a lot of evidence that the NBFC problems, which have been going on for years, continue to have collateral damage on the on the financial system. We've had a very delayed resolution of the Yes Bank issue, which is still really not properly resolved. So all this, I think, has led to bearish sentiment on foreign investors towards India. What's remarkable, it's an indication of how bearish foreign investors are towards India, that the Indian market did so badly even when the oil price collapsing. And then we had this health scare now, and we had the shutdown in activity, which appeared to foreign observers to be quite chaotic. So that, I think, has further reinforced the bearish sentiment. But what we don't really know in India, at least I don't know, how bad this virus really is in India. It's not clear to me personally, although I'm not a medical expert, but it's not far from proven that this virus flourishes in hot tropical climates. Since it's a flu-like virus, which began in the northern hemisphere in China, I can see it can flourish in air-conditioned offices and office buildings, but to me it's not proven that this virus is basically flourishes tropical climates. If it doesn't, then it's a limit to how bad it's going to get in India. But the point is, I would argue lockdowns in activity in Western economies where you have health systems and you have huge fiscal room for maneuver, and you can introduce policies where you pay employers to employ people to do nothing for 3-4 months while the health crisis is in place. It's much harder to implement such policies in India. So there's a real risk in developing countries like India, that the measures taken to protect the population from the virus actually end up being more negative than the virus itself in terms of the impact on the economy and people's welfare.
Chris, according to your model portfolio, you are still overweight India. Within India, your model portfolio always has been tilted towards private banks, insurance, and HFCs. Given that financials are a leverage play, do you think they run the risk of underperforming massively because financials are underperforming and leverage plays in an economic slowdown, they're always hit the hardest?
I reduced my weighting in India since last summer. So I'm just above neutral. My model portfolio is different, that's stocks, but in my country portfolio, I'm marginally overweight India.
Okay. Now, what's your view on financials? Because you've been a long bull of Indian private banks, Indian insurance, HFCs.
Well, I think the risk to my portfolio, so yes, the risk in India right now with the lockdown in activity is that the asset qualities in the banking, the asset quality problems in the banking system, which were very much in the developer space, housing finance company space as a result of the NBFC lending squeeze. The risk is that we now have asset moving into the consumer lending space. So I believe that is a risk facing the Indian market now, which has definitely been compounded by this lockdown in activity. So I'm personally hoping that the lockdown in activity in India is gradually eased. And I'm hoping that I can't discuss specific stocks, and I'm hoping that the names of my portfolio will have the best of the consumer lending, have the best quality consumer loans. But there's clearly a risk to the consumer lending portfolios in India right
now. Where do you think the global fiscal mess is headed? If everybody is printing more money, if interest rates are going to remain low, I wonder what will happen to things like fiscal deficit, trade deficit? What kind of economic imbalance do you think we could be staring at, given that central banks right now will only do one thing, which is print money and print more money and print more money?
Yeah, so the risk is it's both a positive and a negative. So the world has embraced the most dramatic stimulus measures in a response to this health crisis. It could be argued that the world has basically panicked. You have had in the Western world policies introduced which are basically very left-wing policies. They're the sort of policies which would have been advocated by Bernie Saunders. Were advocated by Bernie Saunders and by Jeremy Corbyn in the UK. The policies that have been implemented have not been labelled by the people implementing them as left-wing. They're just saying they're doing it because of the crisis. But the reality is they're not very different from the sort of policies Saunders and Corbyn would have recommended. So the risk longer term is that when this virus has disappeared from the headlines, we still have these policies in place, and the risk is once you introduce these policies, it may be harder to remove them. So take the example, in my view, it's totally justified to be paying for governments to come up with schemes to pay small businesses money to pay the wages for 3-4 months because the government's mandated this lockdown inactivity. But obviously that policy is still in place in 9 months' time. It'd be a different story. Similar with giving banks exercising forbearance, not collecting mortgage interest, say, for 3 months during the lockdown. That's perfectly justifiable. Again, but if such forbearance schemes are extended, that becomes a long-term negative. So there's an issue here where they've introduced these policies, and will they be easy to pull them back? The Fed has now gone into unlimited quantitative easing. The Federal Reserve is now buying corporate bonds in America. The Fed never did that during the global financial crisis. The Fed's buying of investment-grade corporate bonds has led to a significant decline in credit spreads in the U.S. since the Fed commenced buying. But what was incredible is that last Thursday night, after the very strong rally in Wall Street, the Fed announced that it would start to buy top-graded high-yield junk bonds. So to me, all these policies, while in the short term they definitely have helped markets rally, create long-term risks. In the big picture, it's also important to understand that the Fed has now started to finance the federal government directly, engaged in direct financing or monetization. In my view, once you enter these policies, it's hard to pull them back. And in the very big picture, I think the odds are now growing that we are seeing the beginning with these policies will mean the beginning of the end of the bull market in treasury bonds in America, which began in 1981. So in my view, this medical care crisis will mark the catalyst for a long-term change where bonds will henceforth dramatically underperform equities. And
Okay, Chris, in your global sovereign bond portfolio, you have a 50% weightage to China, where the yields are at 2.5%, and only a 10% weightage to India, which offers a yield of 6.5%. So given the fact that Indian yields are high and the scope for interest rate cut is very high, why do you have a 10% weightage to Indian bonds in your sovereign bond portfolio?
This portfolio. So this portfolio was designed for global bond investors, and the message of this portfolio is because the Fed has embraced direct monetization, and because the G7 central banks have become even more committed to extremely unorthodox policies, which are not bond market friendly, I'm recommending global bond investors with G7 portfolios to sell all their G7 government bonds and instead own Asian government bonds. And that's the context. But I have the biggest weighting in China because China is the most responsible global central bank right now and fiscal entity. So in response to this health crisis, China has done much less stimulus than almost everybody else, and yet the epicenter of the crisis was China. Indian fiscal accounts are much more out of control than China. But I agree with you, you do get compensated for the yield. But this is a bond portfolio, so it's first and foremost conservative. The key point to understand right now is not whether you're in India or China bonds. The key point to understand is that the bull market in U.S. Treasury bonds, which began in 1981, well, in the short term, bonds will continue to do okay because the economy is collapsing in the U.S. with the economic lockdown. This policy response marks the beginning of the end of the long-term bull market in Western government bonds. And the asset class which will benefit most from these policies long run is gold.
Okay. Would you say that one should ideally have 10 to 15% exposure to gold, because if equities have a problem in terms of growth, and if yields cannot come down any longer because of almost negative interest rates in Europe and zero interest rates in US, do you think one should have a disproportionately high allocation towards gold?
Yeah, and I think if you're in the West, you should. I think if you're in India or emerging markets, you know, as you rightly say, you've got higher yields in Indian bonds, but I definitely think people should have a weighting to gold, even in India. The other point to consider, the other reason why I've launched a sovereign bond portfolio is because, in my view, let's say the virus ceases to be a crisis in 3 months' time, but many of these stimulus policies will still be in place. It will be hard for the authorities to remove all the stimulus, especially before a presidential election. And then the markets will start to focus on the potential for a V-shaped rebound. And then you can see selling pressure hitting the bonds. At that point, if not before, I'm expecting the Federal Reserve to do a version of what the Bank of Japan has been doing in recent years called yield curve control, where the Fed will basically fix bond yields up the yield curve. They will just do price fixing on government bond yields. That will lock bond investors into very low nominal yields, and that's another reason why you don't want to own Western government bonds. So such a policy will make bonds in Asia emerging markets more attractive, because I'm not expecting the RBI to fix the 5-year government bond yield in India, for example, and that will also be gold bullish.
Okay. Chris, as a theme, if I look at your stock portfolio, you have the highest weightage towards Indian insurance companies, both life and general. If I combine that total weightage, it's about 15% of your total model portfolio. You're recommending your clients that should be in Indian insurance companies. Why is that?
I just think that's a long-term story based on nothing to. Basically, I've just shifted more from the lenders to the insurance in the last year, 18 months. But in the short term, both these sectors have been hit by the crisis. But I just think there's more credit risk on the consumer lending side. Now, do
you think in India we could see a large uptick in retail delinquencies?
Sorry?
Do you think in India now we run a risk of having large retail delinquencies? Like you said, consumer delinquencies could go higher?
I lost that question, sorry.
No, Chris, do you think that Indian private banks now run the risk of huge consumer delinquencies, retail delinquencies?
Definitely that risk is there, absolutely. And the longer the lockdown goes on, the bigger the risk.
Chris, you don't have large exposure to pharma or IT. Where do you think those two defensive sectors are headed? Because Indian pharma, Indian IT companies do not have leverage on their portfolio. Do you think one should now buy stocks and companies both in India and outside which don't have a balance sheet risk?
No, right now those sort of stocks will be definitely will do better. While you've got this whole globally, companies with high debt have been vulnerable the moment this sell-off kicked in. So to me, those all these defensive sectors benefits. Telecom would be another example. But in the long run, I think this whole crisis will be another positive for e-commerce and another positive for the whole 5G story. And so any companies geared into that will be beneficiaries. Also, this whole crisis lockdown activity has further reinforced concerns about supply chains. But in the short term, while markets are correcting, pharma and software are obviously going to appear more defensive. Yeah.
Okay, just two more last follow-up questions, Chris. I know I've extended my appointment with you. With each crisis, there is a change in the equilibrium of the world. Opportunity and threat, they both get created. So to your mind, because of the coronavirus crisis, what could be the new normal for financial investors, for companies, and for investors?
No, I think the biggest issue out of this is what I said earlier. Does it mark the beginning of the end of the bull market in bonds, which has been in place for so many years and has created this long-term disinflationary trend? Because the Fed has now embarked on direct financing of the U.S. government. Now, if the crisis ends, maybe all these policies are removed, in which case making too big an issue of this. But we know from the experience of the introduction of quantitative easing in 2008 in response to the global financial crisis, it was meant to be temporary, but the policies were not removed. So the question is, does this much greater government involvement in economies or central bank involvement in economies remain, or does it reduce? Again, in Europe, banks have been ordered not to pay dividends. HSBC was ordered by the British regulator not to pay a dividend. Do these sort of policies remain in place, or are they removed? Are forbearance policies ordered by governments or banks to implement it? Do they remain in place, or are they removed? This is the big issue.
Okay. Last question, Chris. If for next 3 to 5 years, if you have to choose just one asset class for Indian investors, which way do you think Indian investors should move? Should they buy index funds? Should they buy gold funds, or should they buy government bonds? I'll say it again. Index funds, gold funds, or government bonds. What should Indian investors do for next 3 to 5 years?
Which side? So you said bond funds? What were the choices? Sorry? Bond fund?
Gold funds,
equity
index funds. Yeah. Gold funds, so index funds, which is equity fund, gold fund, or government bonds, sovereign bond.
Well, I would never buy an index fund because I don't believe in indexation. But what I would do is I would hedge it. I would own an Indian equity fund. I would have 2/3 in an Indian equity fund and 1/3 in gold. But I wouldn't have an index fund.
Well, Chris Woods, really appreciate your time. I know you've taken time out in between meetings to join us at a very critical juncture. Really appreciate your time and really appreciate your take. And Aisha.
Okay, well, thank you very much. Thank you. Okay.
You've always called him the eternal bull, but the eternal. Thank you very much, sir. He's this eternal bull, Aisha. I mean, I've interacted with him for over 15 years now, and he's been double overweight India, sometimes extremely excited about private banks. But look at the man now. He's not bullish on India. However, he feels that you need to buy gold and you don't need to buy private banks. When did we hear that last? He's saying that don't buy private banks, but do buy, Aisha, according to him, private insurers. Now that's a very interesting change in terms of a thought and in terms of a model portfolio allocation from Chris Wood, who we've always seen him, heard him, interacted with him as the ultimate India bull. Jo bhi ho jaye, Chris Wood hamesha bullish rahega. But now he's actually neutral, and he feels that in the short term, gold may outperform, and private banks could see a delinquency problem because of retail delinquencies.